Welcome to the deep dive. We've just been digging through AT&T's Q3 2025 earnings, the reports, the press
Oh,
releases.
quite a stack of material.
It really is. And what jumps out is this picture of a high-stakes transition happening right now. We want to get past just the headline numbers.
Right, understand the core mission,
Yeah,
because they're really juggling two big things here.
exactly. What is that dual strategy?
Well, on one hand, they're definitely seeing success, growing the modern stuff, 5G, fiber,
Yeah.
getting those durable connections.
Okay.
But on the other side, they're having to manage this really difficult, expensive decline of the old legacy copper business.
And management sounds, well, pretty confident they're pulling off this balancing act. The sorts that say, customer demand is still strong and they're on track for their full-year guidance.
Yeah, they reiterated guidance, which is always a good sign.
So let's grab your attention right away with a couple of key numbers. Total revenue for Q3, $30.7 billion.
Solid number.
But the one that really matters for their strategy, their ability to take risks, free cash flow, FCF, that jumped to $4.9 billion.
Yeah, up from $4.6 billion last year. And that $4.9 billion FCF, it's incredibly important.
Why is it so crucial right now?
Well, it's not just a good number in isolation, it's the cushion they need. It lets them absorb the huge temporary debt hit from those big acquisitions we'll get into.
Ah, okay, so it funds operations, dividends.
Exactly. And still leaves billions for growth, even with those deals looming.
Okay, let's unpack this. Let's talk about the strategic priorities. The 2025 plan, because it's not just growth, right? It's
Yeah.
efficiency, managing risk.
Definitely. Priority one is kind of the obvious one. Grow those durable 5G and fiber relationships.
Right.
And specifically getting more converged customers, people buying both mobile and broadband from them.
That's the sticky, high-value customer.
Precisely. Then priority two is about financial discipline, really, driving efficiency.
How much are they targeting?
Over $3 billion in run rate cost savings by the end of 2027. They're talking about using AI, streamlining, and importantly, that includes managing that complex, costly transition off legacy copper onto the new 5G and fiber.
That sounds expensive.
It is. And the final piece, priority three, deliberate capital allocation, shows the scale of their commitment.
We're talking big numbers here.
Yeah, investing $22 billion to $22.5 billion this year just on 5G and fiber buildouts.
Wow. Now, sources say something interesting. 2025 is supposed to be the peak investment year for wireless modernization.
That's what they're indicating, spending very heavily right now to lock in that future network position.
Okay, but that kind of spending, it needs a healthy balance sheet underneath it all. How did the consolidated financials look in Q3?
Pretty robust, actually. Adjusted EBITDA, think of it as core operational profit, grew 2.4% year over year, hit $11.9 billion.
So the underlying business engine is running well.
Seems like it. The operational machinery looks sound.
My eyes always go to the debt, though, especially with AT&T's history. They need discipline now, given what's coming, right?
Absolutely. And they hit their target. Net debt to adjusted EBITDA came in at 2.59x in Q3.
So just inside that 2.5x range goal, they said.
Exactly. And for you listening, staying in that range is critical. Investors, rating agencies, they watch that closely. It signals responsibility, capacity to borrow.
And hitting it now is important because they know that number's about to go up, temporarily at least.
Precisely. They know they're about to take on that debt spike.
And even before taking on new debt, they're sending cash back to shareholders.
Yep. $8.6 billion return year to date through dividends and buybacks. $1.5 billion in share repurchases just in Q3.
That's a significant return. Okay, let's shift to the growth engines then. Mobility and consumer wireline. This is where the strategy hits the real world.
And mobility looks undeniably strong. 405,000 postpaid phone net adds in Q3.
That's a solid number. High-quality growth too, right?
Seems like it. Pushes their total postpaid phone base to 73.8 million subscribers. Huge base.
And the revenue follows.
Yep. Service revenue up 2.3% year over year, $16.9 billion. And maybe more importantly, churn people leaving was low. Postpaid phone-only churn at 0.92%.
Keeping it under 1% is key. Shows customers are sticking around.
Right. Satisfaction seems okay, but what's really fascinating is how mobility's strength connects directly to consumer wireline.
Through that convergence strategy.
Exactly. The two segments feed each other. Look at fiber. 288,000 net adds in Q3.
Pushing them past 10 million total fiber subs now.
10 million, yeah. That kind of scale shows the strategy is really landing.
And the money follows there too.
Big time. Fiber revenue grew significantly up 16.8% year over year, reached $2.2 billion. It's not just volume, it's higher value too.
How's the ARPU, the average revenue per user?
Also up. Fiber ARPU hit $73.48. That's up 4.4% year over year. Shows some pricing power, ability to upsell.
Okay, but the key conversions metric.
That's the one. Over 41% of AT&T fiber households are also taking AT&T mobility.
41%, wow.
That creates massive stickiness. If you have both, you're way less likely to drop either one.
Makes sense. We should also mention AT&T Internet Air, their fixed wireless product.
Right, that added 270,000 net adds. It's clearly playing a role.
Filling gaps where fiber isn't yet.
Exactly. A solid secondary broadband option. Helps grab share quickly.
Okay, so that's the growth side.
Yeah.
Now, let's transition to the harder part, managing business wireline. Still heavy on that legacy copper.
Yeah, this is the flip side, the part that needs those aggressive efficiency drives. It's a significant drag, frankly.
How bad was the decline?
Total business wireline revenue was down 7.8% year over year, and EBITDA, the profit, dropped even more sharply, down 12.9%.
That's a major headwind for the overall result.
It really is. Secular pressures, you know?
Almost 8% down is tough. If you dig in, does it show where the pain is?
Oh, yeah. The legacy and other transitional services revenue, that plunged 17.3%.
Oof, brutal. Is that accelerating? And how are they managing the cost of, ripping out copper?
Well, that decline is sort of the point of the strategy, weirdly. It reflects that high cost and complexity of moving customers off copper onto fiber and 5G.
So they're actively shrinking it.
Right. Shrinking the unprofitable parts. The good news, sort of, is that the growth within business fiber and advanced connectivity, that was up 6.0%.
Okay, so it's a race. New services growing, old ones shrinking fast.
Exactly. A race between the new and the old.
But there is one consistent bright spot in the business segment, right? FirstNet.
Absolutely. FirstNet, the public safety network that continues to be a fantastic franchise for them, added another 316,000 connections in Q3.
What's the total now?
Up to 7.8 million connections for first responders. It's specialized, high-priority, stable government revenue, largely separate from those legacy wireline issues.
Okay, so Q3 sets the stage, good momentum, managing challenges. But here's where it gets really interesting.
The big bets.
The massive, multi-billion-dollar deals designed to lock in network dominance for, the next decade?
That seems to be the plan. The first one, the biggest one. $23 billion for EchoStar spectrum.
$23 billion. What exactly are they buying?
Capacity, basically. A huge chunk of valuable spectrum. 30 megahertz of mid-band, 20 megahertz of low-band. Nationwide coverage, pretty much.
So this is about future 5G speeds, handling more traffic.
Exactly. Buying the highway lanes for the future. Expected to close first half of 2026.
Huge bet, but the financial impact must be immediate and pretty profound. This tests that debt discipline we talked about.
It absolutely does. They hit 2.59x debt ratio in Q3, like we said, but the sources are clear. After this deal closes, that ratio jumps up into the 3.0x range temporarily.
So they're willing to take on that extra leverage.
They are, because they see the spectrum as absolutely essential, non-negotiable for future competition. They project getting back to the 2.5x target range within about 3 years after closing.
It's definitely a calculated risk, prioritizing the network over short-term balance sheet tidiness.
That's the trade-off they're making.
And then there's the other deal, $5.75 billion for Lumen's fiber assets. This one is purely about footprint expansion, right?
Pure fiber play. Expected to close early 2026. And this one is structured really strategically to mitigate some of that risk.
How so?
The plan is to put these Lumen fiber assets into a new subsidiary. They're calling it Network Co.
Okay.
Then, within 6 to 12 months after closing, they intend to sell a partial stake in Network Co. to an equity partner. Someone to co-invest.
So bring in outside capital to help fund it and pay down debt faster.
That seems to be the idea. Allows them to grab the assets now, secure the footprint, then find a partner to share the load. Financial engineering meets operational expansion.
Smart.
And like EchoStar, the immediate financial impact is expected to be pretty immaterial for the first year or two.
Yeah.
But long-term, it should be hugely accretive, meaning beneficial, as they plug that fiber into their convergence machine.
Okay, so summing up. Despite planning for this temporary debt increase, spending $22 billion on CapEx this year, they still reiterated strong guidance for 2025.
Confidence seems extremely high. They expect adjusted EPS to hit the higher end of the $1.97 to $2.07 range.
Higher end, okay.
And FCF guidance remains low to mid $16 billion for the full year. And looking further out, those 2027 targets are ambitious, but clearly depend on pulling off these deals.
What are they aiming for by 2027?
Free cash flow of $19 billion plus, and adjusted EPS growth accelerating into double-digit percentages.
Wow. Okay, so pulling it all together for you, the listener, what does this all mean? Q3 shows AT&T is executing that core strategy pretty well.
Yeah, sustained good quality subscriber growth in both 5G and fiber. That's generating the strong cash flow they need.
Right. The cash flow needed to make these massive bets on future network leadership. But these recent deals, EchoStar and Lumen, they signal a huge commitment, even if it means messing with the debt ratio for a bit.
The Q3 results give them the momentum, the financial foundation to actually absorb these big investments. But yeah, being willing to push the debt ratio to 3.0x for that EchoStar spectrum, that shows securing future network capability is priority number one right now.
They're betting that capacity will be absolutely critical down the road.
Seems like it.
And that brings us to a final thought for you to chew on. We know they expect $19 billion plus in free cash flow by 2027. We know the debt ratio is going to spike temporarily after EchoStar. So how absolutely critical is finding the right equity partner and finding them relatively quickly for that new Lumen fiber business, Network Co.? How much does successfully selling that partial stake speed up their plan to get the debt back down towards that preferred 2.5x target? It feels like that partnership piece is a really crucial part of making the whole plan work smoothly.
It definitely seems like a cornerstone of their deleveraging strategy post-acquisitions. Finding that partner quickly will be key.